Welcome to our channel Passive Income Playbook. In today's video, we're going to dive into a popular investment strategy, investing in dividend stocks. Dividend stocks can be a great way to earn passive income while still growing your portfolio. Whether you're a seasoned investor or just getting started, stick around, and by the end of this video, you'll have a clear understanding of how to invest in dividend stocks and maximize your returns. So let's jump right in. First, let's cover the basics. What are dividend stocks? Dividend stocks are shares of companies that regularly pay a portion of their earnings to shareholders in the form of dividends. This income can be paid out quarterly, semi-annually, or annually, depending on the company. Dividends can either be reinvested into more shares or collected as cash. Unlike growth stocks, which are focused on capital appreciation, dividend stocks provide investors with consistent payouts. They tend to be from well-established companies that are financially stable, like Procter & Gamble, Coca-Cola, or Johnson & Johnson. Now, why should you consider investing in dividend stocks? The primary reason is that dividends provide a steady stream of income. This can be particularly beneficial for retirees or anyone looking for additional passive income. Dividends can act as a hedge during market downturns. Even when stock prices drop, you'll still receive your dividend payments, which can soften the blow during tough economic times. Additionally, companies that pay dividends tend to be more stable and less volatile than non-dividend paying companies. Lastly, you have the option of reinvesting those dividends to buy more shares, creating a compounding effect. Over time, this can result in substantial growth. Before we dive into how to choose the right dividend stocks, there are a few key terms you need to understand. 1. Dividend yield. This is the annual dividend payment divided by the stock price. For example, if a company pays $2 in dividends and the stock price is $100, the dividend yield is 2%. A higher yield can mean more income, but be cautious, higher yields can sometimes indicate that a stock is risky. 2. Payout ratio. This is the percentage of earnings that a company pays out as dividends. A payout ratio of 40-60% is typically considered healthy, as it indicates the company is balancing paying dividends with reinvesting in growth. 3. Dividend growth rate. This measures how much a company's dividend increases over time. Companies that consistently grow their dividends are often considered safer investments. 4. Ex-dividend date. If you want to receive the next dividend payment, you need to own the stock before the ex-dividend date. Buying the stock on or after this date will make you ineligible for the current dividend payment. Now that you know the basics, how do you actually choose the right dividend stocks for your portfolio? There are several factors to consider. 1. Financial stability. Look for companies with strong fundamentals, low debt, consistent earnings, and positive cash flow. A financially healthy company is more likely to continue paying dividends. 2. History of dividend payments. Choose companies with a long track record of paying and increasing dividends. The dividend aristocrats, for example, are companies that have increased their dividends for at least 25 consecutive years. 3. Sustainable dividend yield. Avoid stocks with extremely high dividend yields. While a high yield may seem attractive, it could be a sign that the stock price has fallen significantly, and the company may be at risk of cutting its dividend. 4. Industry stability. Focus on industries that are less cyclical and more stable, such as utilities, consumer staples, or healthcare. These sectors tend to perform better during economic downturns and continue paying dividends. By focusing on these criteria, you can build a dividend portfolio that provides reliable income over the long term. Let's talk about some popular strategies for dividend investing. Whether you want to play it safe or take on a bit more risk, there's an approach for everyone. 1. The dividend growth strategy. With this strategy, you focus on companies that consistently increase their dividend payouts. This can lead to both income and capital appreciation over time. Many long-term investors prefer this approach because it provides a growing income stream. 2. High yield strategy. This strategy focuses on stocks with high dividend yields, providing immediate income. While the returns are higher, it can be riskier, as companies with high yields may face financial struggles or cut dividends. 3. Dividend ETFs. If you're looking for diversification and simplicity, consider dividend-focused ETFs. These funds invest in a basket of dividend-paying stocks, allowing you to spread your risk across multiple companies. Popular examples include the Vanguard Dividend Appreciation ETF, VIG, and iShares Select Dividend ETF, DVY. 4. Reinvesting dividends. One powerful strategy is to reinvest your dividends. By automatically using your dividend payouts to purchase more shares, you benefit from compounding returns, which can grow your portfolio faster. While dividend investing can be rewarding, it's important to understand the risks involved. 1. Dividend cuts. Companies can reduce or eliminate dividend payments during tough times. Always keep an eye on a company's financial health to avoid surprises. 2. Interest rate risk. When interest rates rise, dividend stocks can become less attractive compared to bonds or savings accounts, causing their prices to drop. 3. Overconcentration. Investing too heavily in dividend stocks can lead to a lack of diversification. Make sure your portfolio includes a mix of assets to manage risk. By understanding these risks, you can make more informed decisions and avoid common pitfalls. Now let's talk about how to actually build your dividend portfolio. The key is diversification and balance. 1. Start small. You don't need to buy 20 different stocks right away. Start by investing in a few high-quality companies and gradually expand your portfolio over time. 2. Mix of sectors. Ensure your portfolio includes dividend-paying stocks from different sectors, utilities, healthcare, consumer staples, and more. This helps reduce risk. 3. Rebalance regularly. Keep an eye on your portfolio and rebalance it as needed. If one stock becomes too large a part of your portfolio, it might be time to trim it and reinvest elsewhere. Ready to get started with dividend investing? Here's a simple step-by-step guide to kick things off. 1. Open a brokerage account. Choose a brokerage platform that offers dividend reinvestment plans, DRIPs, and low fees. 2. Research dividend stocks. Use financial websites or apps to research companies that have a strong history of paying dividends. 3. Start small and be consistent. Even small investments add up over time. Consistency is key when it comes to dividend investing. And remember, dividend investing is a long-term strategy. Be patient, and over time, you'll see the benefits of a growing income stream and portfolio. That wraps up today's video on how to invest in dividend stocks. If you found this video helpful, be sure to give it a thumbs up and subscribe for more investing tips and strategies. Have any questions or want to share your own dividend investing experience? Drop a comment below. Thanks for watching, and we'll see you in the next video.